Today, we explore the potential impacts of a second Trump presidency on trade, fiscal, and monetary policies. The US economy is facing significant challenges such as inflation volatility, frequent supply shocks, and structural labor shortages. These factors make the economic landscape more unpredictable. One major concern is how demand-boosting policies like tax cuts or supply-hurting policies like tariff hikes could reignite inflation, leading to higher interest rates. Social tensions and fiscal trade-offs also raise questions about the future direction of fiscal policy. However, the rollout of artificial intelligence may boost productivity and GDP growth. In this report, we will delve into what a Trump return could mean for growth, inflation, and capital markets. The transatlantic partnership could face far-reaching questions, from resolving the Ukraine conflict to exiting the Paris Accord. Focusing on economic policymaking, we identified three main fault lines. First, the potential return of the trade war with increased tariffs and industrial subsidies. Second, the fiscal policy approach, which may follow the 2017 to 2019 playbook, contrasting with Biden's promised fiscal cliff. Lastly, the conduct of a credible monetary policy amidst risks of stagflation caused by protectionism, fiscal profligacy, and interventionism. We expect tariff increases to be more moderate and targeted, although still substantial. Record high tariffs could hurt the US economy more than in 2018 to 19, leading to inflationary pressures. Our baseline scenario predicts Trump could increase the effective average tariff rate to around 4.3%, the highest since the mid-1970s. This would involve a crackdown on tariff evasion. The crackdown on tariff evasion could push up short-term inflation by lengthening suppliers' delivery times. A stronger USD could mitigate this effect. Additional customs duties might be recycled into industrial subsidies to support the economy, potentially reducing US and global economic growth. In a downside scenario, effective tariffs could reach 12%, the highest since the early 1940s, with significant GDP impacts. Goods not critical to the US economy, such as Chinese textiles and EU imports, would likely be targeted, significantly affecting these sectors. Fiscal policy is expected to be cautious, with a Trump 2.0 presidency inheriting large fiscal deficits and rising interest expenses from the Biden administration. Large deficit finance tax cuts or increased spending could reignite inflation and raise concerns about the sustainability of US public finances. Fiscal hawks among Republicans might resist large tax cuts or new spending due to the poor state of US public finances. A Trump administration might also recognize the challenge of reducing the trade deficit while maintaining large public deficits. We foresee the Trump administration funding fiscal pledges through increased customs receipts and repealing some of Biden's policies. Overall, the fiscal stance might be slightly loosened initially, but turn neutral in later years. Some of Biden's green subsidies would likely be replaced with new subsidies for technological sectors and supply chain strengthening. We anticipate non-green industrial subsidies to increase by around $55 billion per year, targeting chemicals, minerals, steel, and autos. Monetary policy could see the Federal Reserve pausing its easing cycle by 2025, with the US 10-year yield staying above 4%. Equity markets might undergo downward adjustment due to the impact of increased rates on valuations. A short-term spike in inflation could prompt the Fed to exercise caution. Treasury yields and policy rates would likely remain above 4%, pressuring equity markets. Although a significant downturn is unlikely, risks will accumulate. Markets might experience lateral movement throughout 2025. Favorable policies and an accommodative monetary policy could positively impact US corporations. In 2026 and 2027, these policies could lead to US markets outperforming international counterparts, with annual returns of 8 to 10%. On the FX market, the stretched valuation of the dollar suggests limited scope for significant appreciation, with an expected increase of around 2.5%. Thank you for watching. Stay tuned for more updates on economic policies and their potential impacts. Subscribe for more detailed analyses and insights.